All right, so once again, Jonah Taylor here of the Smart Move Group, and we got our mortgage expert, Peter Brock from Apex Home Loans. How you doing, man?
Doing very well, thank you. Thanks for having me.
Yeah. Well, I wanted to follow up on some of the lending questions that I get asked as a realtor quite often, and quite frankly, I give them, as much information as I guess I can, I'm allowed to, but really I'm pointing them back to you, right? And that's really your field, your expertise. So the three things I seem to get asked about a lot are credit score or credit challenges, down payment, and then closing costs, right? I think these are kind of the three main factors that people want to know about up front. And so I thought, this is perfect. Let's get with Peter on this. So, Peter, being the mortgage expert, what are some general rules of thumbs or generalizations in reference? Let's start with credit score. And just so, what can you help us with that? How can we understand that?
I think the big thing about credit scores is to know that the mortgage score, the score you get when we run your credit as a mortgage company is going to be different from your Credit Karmas of the world and what your bank tells you. They use different scoring models. Okay. So while you might see a score of 720, we might run it and get a score of 690, or maybe it's the other way around. We might get a score of 750. That those consumer reports is what they're called. They're good to know. It's good to monitor your credit and stay on top of things with it. But just don't be surprised if we run your report and we have a very different score.
Now, why is that, Peter? Why do you think that your guys's are
Well,
different than theirs?
we use different scoring models. That's the only reason why. So we put different weight on different things. For example, obviously your delinquency of payments is going to be a big one. If you have any delinquency of payments, but your payment history. Your credit utilization ratio is the big one that most people aren't aware of. They are aware of it, they just never hear that term. But if I have $10,000 of a credit limit and I'm using $5,000 and that's my balance, I have a 50% utilization ratio. We're going to give that a larger weight than, say, your consumer report might. So our credit utilization ratio is a bigger factor. Reasons like that they just give us different scores because they're different models.
Gotcha. So I like that. So really like delinquency rate and like you said, credit limit utilization. It's just nice to kind of know that because most people probably know where they are in the back of their mind. Like, man, I'm pretty maxed out, right? Or I know I missed a few payments, or maybe they're the other way and they go, man, I know I got plenty of credit and I've made all my payments. Just good rules of thumb, to such stuff. So is there like, and I know probably can't say a number per se, but is there like a range where you're good, or maybe we need to do some work? What is that?
In terms of a score or a utilization ratio?
Yep. No
a score. If your score, well, for one, if your score is above a 740, you're golden. Okay.
So 740 and up.
740 and up, you're the top tier. I think 840 is the highest score you can have. I've never seen somebody with an 840. I've seen like an 837 and 836. I've seen some pretty high ones. But if you're above a 740, you're golden. If you are, let's say you're down to that 700 range, you shouldn't be turned off to buying a home at all, though.
Yeah.
That's still good credit. When you start drifting down into the 600s, you need to start thinking about what am I really doing with my credit? How can I improve my situation? Doesn't mean you can't buy a house and under some pretty decent terms too. But it means you really should probably put a little more weight into your credit decisions from a day-by-day standpoint.
Gotcha. Okay, so that's good. So really, 700 and above, you're great. 600 doesn't mean that you're done. You can't. It just means that there might be a little bit of work that needs to be done, or maybe don't shoot for the moon. With what you're looking at.
I like to tell people when I see credit scores, below 700. I tell people, look, you still qualify for a mortgage, maybe even the exact mortgage you want, but you might not be the conversation starter at the cocktail party. Your rate's not going to be phenomenal,
Right.
But you still get in the home and you build the credit and you refinance later. So yeah, when you get under the 700, it's time to be more cognizant of what you're doing with your credit situation.
Gotcha. And what about, so we get plenty of people I know that just whether it be life or circumstances, and their credit is just really, really, really bad, and they know it. Right. And they're very aware of it. In those cases, what can we do, or what can you do, or how do you approach that? Like people in the 500s.
Yeah, there's a few things to do. Number one, the first thing is to stop shopping for credit and stop using your credit. it's time to change your lifestyle a little bit and start thinking about what can I afford with my monthly income. Because that right there, stopping the pattern that got you there is the big deal. Some people are stuck in kind of past circumstances. I had a collection a long time ago or a bankruptcy 5 years ago. Why isn't my score improving faster? And those things can lag. They really can. They can bear on your score for a long time. But what we do from a mortgage application standpoint specifically is once we look at your credit report, we run it through our software and we say, okay, and every lender really has this software. It's not proprietary to Apex, but you run it through the software and you say, okay, if I pay X amount down by X amount of dollars, where will it take my score and in how long? And so we kind of plan for a credit improvement, and that can be immediate. Sometimes it's like, hey, just pay down your balances by $400 and now you're at you built up 20, 40 points in your score. Sometimes that's a 3 to 6 month window or longer, but at least we can put you on a track to get somewhere.
Gotcha. So it really, even if you have a poor credit score, it doesn't mean that you're years out or the answer is no. It just means there might be a little bit of work, maybe months, even just as little as months of work before they could be buying a home.
I think what I tell everybody is I don't like to say no, but I like to say how. And so, it might not be a yes right now, but there's definitely a path to get you there. And mortgage planning it's fairly undervalued. It's underutilized. We are, as mortgage lenders, we're the debt side of your personal balance sheet. Yep. And while you might be able to manage your assets very well and your income, what are you doing about your debts? And that's what we're focused on. We're the debt side. And there's a way to get to that to leverage it properly. And it's just a matter of kind of putting it in place. And if you feel like your credit is not perfect or in tip-top shape, you should still apply for that mortgage early. The earlier you do it, the better, because that way you can say, okay, now I know what I need to do to get where I need to be so I can be where I want to be.
That's really interesting, because I think most people have the opposite mentality. They go, I know my credit's bad. I've seen it on Reddit, whether Credit Karma or whatnot. I know it's bad. I need to fix it on my own, and then I'll reach out to a lender. You're saying wrong. Reach out to me first, because I can actually help you get there much faster.
Yeah, you got to plan. You got to plan properly. There's a way to do it. And everybody says, well, I'll just pay down my credit cards. Well, some credit cards are better to pay down than others.
And
some will impact your score differently. Yeah, we can show you that and say, listen, if you pay down these credit cards and just keep making your payments on the other one, but pay down these credit cards specifically to these balances, you will see an uptick in your score. And that way people aren't just throwing money at credit cards saying, oh, let's hope this works in a year. Right. There's a strategy to it. It's time to build it.
It reminds me of, I used to be a personal trainer like 10 years ago, and it just reminds me, I would reach out to them and say, hey, are you ready to get started? You ready to get started? And they say, I'm going to get in shape. Once I'm in shape, then I'll reach out to you. And I would always say, don't you realize that's literally the point of me.
That's right.
Hey, once you're in shape, you don't need me anymore. But their whole mindset was, well, I'm too slow. I'm not fast enough, or I'm overweight. I got to get in shape first. Backwards, right? Exactly what you're saying. I love it. Yeah. Okay. I think that gives, honestly, that's a great kind of breakdown in simplified layman terms of credit score and credit in general. So let's kind of shift gears to, all right, so say they understand that now, down payment. Mm-hmm. What kind of rules of thumbs do you give or just talk about with down payment?
My rules of thumb is you do what's comfortable. It's great to have 20% down. The Federal Reserve has white papers all on their website. I wish I could point it to you, the exact hyperlink. I don't have it, memorized, but I read a white paper that they put out, and the statistics behind people who had put 20% down their mortgage versus those who did 3 to 5%, the wealth position those people were in 20, 30 years later was exponentially different. So if you can put down 20% or more, you should. It's a good investment in yourself and in your future wealth and livelihood.
Yep.
If you can't, that's okay. And you shouldn't be scared because you can't put down 20%.
Right.
So my rule of thumb is do what's comfortable.
Okay.
Yes, there are some economic answers that make better sense than others, but getting into a home, if I know I have stable income, I know where, generally speaking, I know where my life is going. I know kind of the career path that I'm on. I plan on being at my job a long time. If you put 5% down, that's okay.
Yeah.
As you start to build equity though, the less you put down in the beginning, what you want to think of is you definitely want to be overpaying your mortgage. It's even more important to do that. So if you can't put down 20% or more, definitely consider in your monthly budget, do I have enough to overpay my mortgage by at least 1/12? Okay. Because one payment extra a year will save you about 6 years on your full 30-year amortization.
Oh,
So
wow.
if you think about that, yeah. So if I want to make one extra payment a year, well, how do I do that? Do I have an extra $2,500 or so laying around, assuming that's your mortgage payment? Maybe not. But you probably have 1/12 of $2,500.
Right.
And just tack that onto your check and send your mortgage payment in. And that, if you can overpay your mortgage, then the less you've put down becomes a little less relevant in terms of a wealth standpoint.
And just to recap, you said 1/12 saves you how much?
So if you make one extra payment a year,
A year.
it'll save you about 6 years on your full amortization.
6 years. So
Six
one
years.
payment per year saves you about 6 years.
Correct.
Yeah. Wow.
Right. And so if you just make 1/12 of your payment extra, by the time you get to the end of the year, you've made an extra payment.
Yeah. Wow. I mean, I love it how just something so small, because 1/12 of even 2,500, we could probably
Minuscule.
all do that. I mean, right now within the virus and this and that, maybe that's not such a, everyone's mindset.
Sure.
But shortly from here, when this passes, that's so doable.
Right.
It
Exactly.
saves you so much. Wow. So obviously the best would be, put that 20% or more down. A lot of loan programs, you can get in with 3.5 or 5. What about like none? No down payment. I don't have any money.
If you have, well, so there's down payment assistance programs. They are county, state, they're jurisdiction driven.
Okay.
All of them have different programs within them as well. So your state of Maryland has 6 programs available to it. And they all have these slightly different guidelines and slightly different features. Do I need 3% help? Do I need 4% help? What are my pros and cons by taking 3% versus 4%? Do I want it forgiven so I never have to pay it back? Or do I want to pay it back? Because those have there's different interest rates associated with those loan programs.
Right.
So there are programs out there for people with very little money on hand.
Gotcha.
And having said that, I still think at the end of the day, comfort is the driver of everything you do, especially when you're managing debt. You're not managing credit when you get a mortgage, you're managing debt. And if you can't be comfortable with your payments and your interest rate and the lack of money that you have in the bank left over, because once you buy that house, every problem in that house becomes yours.
Right.
You might be renting and the dishwasher breaks and you just call the landlord up or the management company and they get it taken care of. Do you have $700 to fix that dishwasher?
Right.
And if the answer is going to be no, and I'm not going to have this for the foreseeable future, well, maybe we should think about saving before getting into this home. What do you do when the HVAC goes out? The big problems, when there's a water problem in your home. It's one thing when the guts of the toilet need to be changed and you drop $25 at Home Depot and spend an hour of your time.
Yeah.
But when your refrigerator stops running or, the stove breaks, now we're talking about bigger things. And anybody who's buying a house with $0 in their bank account, I get nervous for personally.
They do, yeah.
I stop and say, well, listen, what's life like for you? Let's ignore your house. What if your transmission goes on your car?
Right.
What are we doing there? And so the idea of house poor is real and people should be cognizant of it. It doesn't mean you can't get a mortgage if you have very little funds, but it means you need to be more thoughtful of what is your game plan for saving money in the short future to make sure that you're stable going forward in life.
I love everything that you're saying, because for you can tell just by the way you're coming off, it's not just about closing a deal or everyone's just a transaction too. You're very much into this. Let's actually dissect your life here for a second, as much as you'll let me in, because I'm actually concerned that maybe if you have nothing up front, then would you be able to afford this house? And I think it's a very real thing. So
when I like to tell people I say this to almost everybody, it's not my mortgage to go home to at night. It's yours.
Yeah.
You have to be comfortable in it. So I'm glad you pointed that out. It's true, because it's not a transaction. This is a very big decision, a very large debt you're taking.
Yeah.
So what are we doing about that financially to build your wealth by leveraging it?
Yeah. Awesome. So great. As far as down payment, there's a wide range, and yes, you can. I guess you pointed out 0% that you can get, but at the same time, just make sure that you can afford that house and the things that come with it.
Right.
So that takes us kind of to that third point. We'll wrap up with this one: is closing costs. So what kind of general rules of thumbs can you share with us on closing costs?
Here's what I like to do. I kind of give people an easy math scenario. If you have 3% of the sales price, if you have that in funds in the bank, if you have 3% of the sales price, you're probably covering all of your closing costs. Okay. If you don't have 3% of the sales price, well, we need to think about that. Is seller help needed? Do we need to use a down payment assistance program which can help cover closing costs? Where are we with that?
Yeah.
Do we want to lower the sales price? And that's usually not the answer, because so many of those costs are fixed anyway.
Right.
So, it really comes down to, if we don't have 3%, okay, then what do we have?
Yep.
And do we need to focus on what kind of program we're doing? Maybe we're lowering our down payment so we have some money available for closing costs. Maybe we're utilizing a down payment assistance program, but putting a little more down so we get some of that kind of offset it. Maybe Jonah calls me and says, hey, listen, we've got a property. And the seller's like, I just have to sell this thing and I'll give you every closing cost dollar that you need.
Right.
And that's where the communication between you and I come into play, and we're having a good team around you, having that dialogue to say, okay, how do we best structure this mortgage,
Right.
or the offer for it? But generally speaking, I think if you have 3% of the sales price, I think you're covered.
That's perfect.
That's
Yeah.
the general rule of thumb.
And I guess just to play off that too, kind of piggybacking off what you said, as a realtor, we can also help with that by being able to, whether it's ask the seller for 1%, 2 or 3 sometimes back in order to help said buyer cover those costs. And that's where you and I get to work together, pretty closely on that. So 3%, I think that's a great number. I think people can really compute that pretty easily, and without getting too convoluted and too tumultuous on the whole thing.
Right.
Yep. Peter, I think that's it, man. That's enough brain power for one day right there. I will let everybody digest that, and just appreciate you jumping on with us, man.
That's awesome. Thanks so much. It was a great time as always.
Yeah. All right. Well, take care. We'll see you soon.
See you, man.